Joining us now is Neuberger Berman multi-asset CIO Eric Knutson and JP Morgan Asset Management Global Market Strategist Jordan Jackson. Good morning to you both. Eric, I'll start with you because you say that challenging growth in an inflation mix is likely to continue here. How do you see it going into 2023?
Well, in 2022, the biggest issue, of course, was high and sticky inflation. We think in 23, the market begins to shift its attention towards a much more challenging growth environment at the same time that central banks need to keep financial conditions tight. Your comments before that and Steve's comments just indicated that central banks were going to finish their process and pause. That means the Fed, and we think you should believe the Fed, is going to raise rates to around 5% and hold them there for 2023, even as inflation rolls over. But remember, the Fed's target for inflation is just over 3% at the end of the year. We're a little higher than that, still coming down, but still above target. That means central banks are going to need to stay on the restrictive side. They need financial conditions to stay tight. And that means that they're doing this all in a time of declining growth and where short rates are now looking interesting, attractive. If you get 4.5% in short-term rates, 2-year treasuries, that all of a sudden becomes pretty interesting relative to equities and other risky assets where there's potential for a lot more volatility.
Okay, I want to get into that more, but first, Jordan, I want to get your thoughts on this. We talk about it day in and day out on this network, the Fed and where the Fed's going and what the Fed's doing and what Powell is saying. But to Steve Leisman's reporting just now, it has not just been the Fed this year. It has been other central banks on the global stage that have been tightening as well. How do you see it going into 2023, and what does that mean in terms of potential opportunities, particularly within global equities?
Sure. So if 2022 was the year of central bank pressure, I think 2023 will be a year of central bank pivots. And I do think most central banks will be finished hiking rates through the first half of next year. I think what's going to be key to watch out for is going to be kind of the wage inflation narrative. And sort of what was highlighted was we're seeing clear signs that supply-driven challenges and supply-driven inflation are going to begin to start to come down. That's going to lead to some negative core goods inflation. But what's going to really allow for that pivot is the demand side, the services side that's going to begin to cool off. And our expectation is that the consumer is going to start to come under pressure really around the second quarter of next year. That should really begin to weigh on demand, also weighing on sort of that services inflation. Housing inflation should really begin to peak out by the end of the first quarter of next year and probably be the primary driver of that core inflation rate down over the middle towards the end of next year. And so I think this does allow for central banks to begin to pivot, but I do think the pivot comes in two waves, right? First is the pivot on where we're finally going to be able to pause, and then the next pivot is going to be when we're going to be able to cut. And I don't think that second pivot happens until the end of next year. So I think you kind of remain defensive in portfolios, and inflation is going to be coming down. That should be a bit of a tailwind for defensives relative to cyclicals. And as was highlighted, you stay a little bit a shorter duration still within portfolios if you're able to get 4.5%, 5% in short-term rates.